Welcome to the Evans Legacy Financial Podcast, where real people have real conversations about money, mindset, and making moves. I'm your host, Jake Evans, and this show isn't about fluff or hype. It's about educating our community, sharing stories, and giving you the tools to make better decisions in business and in life. Let's dive in. Good morning, everybody, and welcome back to the show. I'd like to welcome Javier Veliz back to us today with his take and his information on long-term care. Last week we talked about Life Insurance 101, basically everything you need to know about life insurance and as far as choosing policy and how much and all that. Today we want to focus on long-term care. So Javier, welcome.
Hey, Jake. Thanks for having me back.
Not a problem, man. I always love having you. So in your experience, why do you think long-term care is such a critical yet often overlooked aspect of financial planning?
Well, the key word there is overlooked, because I find that most people really start to want long-term care when they've already have got to an age where they can't reasonably be able to get it.
Okay.
So when you start to hit your late 70s, like say 75 and above, that's when I start getting the phone calls from people that ask me, hey, how do I go about getting this long-term care? Because they find out very quickly that Medicare doesn't pay for long-term care. Medicare only pays for your hospitalization and your doctor's visits and those types of things. The long-term care is something that you can't get unless you pay for it out of your own pocket, an insurance company pays for it, or you qualify for the Medi-Cal system, which means that you've given away all of your assets in order to be able to qualify for the Medi-Cal system of long-term care.
All right. Well, that's good. And we talk, that's our point today. Our first talking point is going to be why long-term care matters. Statistics about home care versus nursing homes, the emotional and financial toll on families without long-term care coverage. So, what are some of the biggest misconceptions people have about long-term care?
Well, I think that people think that it's overly expensive. That's not, it is true. It is overly expensive if you get to it at the wrong age. If you start young enough, you can get it for a relatively inexpensive plan. Another misconception is that it's only if you go into a nursing home. Most plans are comprehensive, which means that it will cover you in a nursing home, or it'll cover you in assisted living facility, or it will also cover you in your home, in-home health care.
So we'll take care of home care as well. Okay. All right. So how do you see the financial impact of long-term care affecting families who aren't prepared?
So the best clients that I have been the clients that have seen the wreckage from their grandparents and their great-grandparents. Because when people don't have long-term care, they see their nest eggs dwindle. And so those nest eggs usually were monies that were going to pass on to the next generation. And then when you have to use that money to pay for that type of care, that type of assistance, it's very expensive at that point, and it erodes the nest egg. And so I'd say when I started in the business 31 years ago, we were taught about long-term care at that point, and at that point I believe long-term care was already in existence for about 10 years, if not longer. But the problem with the long-term care plans that started in the industry when I started 31 years ago, those plans, there was no history of claims paying history at that point. What happened was people were buying these plans to protect themselves against seeing what happened with the other generations ahead of them. And when they purchased those policies, the insurance companies built the product based upon the actuary lapse ratios of life insurance policies, automobile, homeowner, different vehicles where they built the actual engine of the premiums. And after I had been in the business for 10 years, then all of a sudden the insurance company started to realize that people were not lapsing these policies. They were holding on to them. And so the insurance company started to realize that they were going to have huge claims in the future. So they started to modify the plans.
Right. Okay. So are there any specific scenarios you've seen where a lack of long-term care planning has led to devastating or financial consequences?
I see it all the time. I've seen it within my own family. I've seen it within other people that I know, other family, other friends. I see it quite often. And the thing that the thing that I tell people, I could just use my grandfather as an example. We had pooled our money together, various family members, and we bought a long-term care policy that he held on to for about 7 or 8 years. But then at some point there was a couple family members that didn't want to pay the premium anymore, and that policy ended up lapsing. And it was maybe about 10 years later, he needed to have convalescent care. And it was expensive. And so I've seen it within my own family. I've seen it with other friends. People talk about it all the time because, I mean, just think about this. Think about the fact that you have somebody who's maybe 80 years old, 85 years old, and they can no longer care for themselves. They can't get up from their bed. They can't walk over to the restroom, use it. They can't bathe themselves, dress themselves, feed themselves. They need to have care. They need somebody to help them. And when a person gets to that point, those things are not covered by Medicare. And so it's just a harsh reality that people start to see as their parents or as their family members age.
Okay. So I want to shift into something, how long-term care works. Explain, we're going to explain the triggers, what triggers long-term care benefits, difference between standalone policies, hybrid life, long-term care policies. So what should listeners know about the different types of long-term care insurance policy available today?
Okay. Well, let me go back to the first part of that where you said the triggers, and because I started to mention the triggers. So there's 7 activities of daily living, and I'll just mention it one more time. It's transferring, getting up from your bed, going over to the restroom, using the restroom, bathing yourself, dressing yourself, feeding yourself, maintaining continence. Those are the activities of daily living. And then another trigger is Alzheimer's or dementia. That's an automatic trigger. And when somebody has 2 of these needs that need to be met, they have 2 of these triggers, that right there is going to be documented in your primary doctor's files. They're going to mark it in the files that yes, you need help in these areas, and then the insurance company gets that information and then processes the claim for the client. What dictates how much benefit you have is how much is your daily benefit. Did you choose $150 a day or $200 a day? And the amount of time. Did you choose a 2-year plan, a 5-year plan, a lifetime plan? There's also a deductible period, 30 days, 60 days, 90 days. So all these different factors go into creating the price for what's called a traditional long-term care policy.
Okay.
A traditional policy that has no life insurance attached to it. It's just pure long-term care. And these are the policies that I started selling at the beginning of my career. As I mentioned, when the insurance companies realized that they were going to be in for huge claims in the future, and I'm not just talking about one insurance company, I'm talking about when I started in the business, there was at least 30 companies in California that were selling long-term care plans. And what happened was slowly but surely, the companies stopped selling long-term care in California. One company after another dropped off. So right now, currently, I believe we have about maybe 4 or 5 companies that still offer just the traditional long-term care plan. But there's not the same amount of competition as well as variants of products. It's just a select number of companies, and the products are very highly priced today. So your other part of the question was the hybrid plans. So it's probably been about 20 years. About 20 years that the insurance company started to make the death benefit of a life insurance policy eligible for long-term care benefits. So, for instance, if you bought a $250,000 life insurance policy and you were able to get it with where it doubles as a long-term care benefit, the idea is that if you live into your older age, you can use the death benefit to pay for long-term care expenses, and it might be a percentage of your death benefit, maybe 2% or 5%, up to usually like 10 or 15,000 maximum that you can have towards paying for your long-term care expenses. That is predominantly how I sell long-term care now, as I include it as a living benefit in my policies, and so when people are buying policies from me that are 25 years old, 30 years old, 35 years old, that is included automatically in the plan, and that's done specifically so that way, it's just an added, protection feature, protecting your nest egg as you get older. You can use your life insurance that way, and if you pass away, then you don't need to worry about that, because then your death benefit gets paid out.
Then you're, as we talked about in the last episode, then your family's taken care of at that point.
Correct.
So I'm looking at the difference between the long-term care and the life insurance. The life insurance takes care of your family after you're gone. The long-term care helps you to have quality of life while you're still here. Mm-hmm. Okay. Mm-hmm. So are there any red flags that people should look for when evaluating a policy?
Red flags, well, I mean, I wouldn't call them red flags. I think the red flag is that you should have something. When somebody has a policy and I'll review the policy, then I'll determine whether or not it was set up properly for somebody. I wouldn't say that there's any red flags, because I'm a believer in having life insurance, and like I said, I'm usually selling the long-term care plan as part of the life insurance package. So
what I'm talking about is evaluating a policy. So you're including that. You're trying to include all of this so that when they do evaluate the policy, there are no red flags.
Sure.
Okay. Mm-hmm. Okay. So we've already talked about what are some of the key differences between standalone policies, hybrid life, long-term care policies, and such. So I want to talk about and choosing the right plan. And we talked about this last time. The right plan is the one you have in place when you're gone. That's right. When you need it, right? That's choosing the right plan. But how do you assess coverage needs based on age, health, financial situation, and that? How do you get with the person physically? I mean, how's that done? Paint me a picture of that when you sit in front of a client.
Sure. Well, I'll give you a real good example right now. I'm dealing with a gentleman right now who is 65 years old, and he has an old universal life policy that he's had for 25 years. He paid in that policy, he pays $200 a month, and the policy has a death benefit of $250,000, and he has cash accumulation of $50,000. So he came to me because he wanted long-term care. He didn't realize that his current policy is perfect for building a new long-term care plan. So his policy 25 years ago didn't have those kind of benefits. So so what's happened is that he also knows that his mother was in a long-term care facility and had to spend a lot of money towards it. So he wants to be able to protect that. But at the same time, he still has adult children that he still cares for and wants to leave them a death benefit, as well as future grandchildren. So he still wants his life insurance. There's a lot of people that, one of the misconceptions is that people think that they're not going to need life insurance after they hit a certain age. Well, if you really think about it, do you want to leave something for your grandchildren or your great-grandchildren? So the life insurance vehicle is a perfect vehicle for it. So how I structured this gentleman, I'll just call him T. So what we did is we upgraded his life insurance policy to a $300,000 death benefit.
Okay.
We increased his premium from $200 a month to $400 a month. And we took the $50,000 and we rolled it into the new plan. Now, this gentleman was really big on guarantees. The reason why he was so big on guarantees is because he thought that his old universal life policy was guaranteed. And I had to show him in his illustration that his policy actually ran out at age 80.
Got it. Okay.
And so he was very upset. He called the insurance company and told them, hey, this is not what I was sold. And then the insurance company just told them, well, this is the way your plan works. So what I had to do was make sure that I built everything on guarantees all the way to age 100 for this guy, for him to feel comfortable moving over the $50,000 and paying the increase in premium. Actually, the increase in premium was from $200, it went up to $450, but it was guaranteed to last until he was 100 years old.
Okay.
So now, if he needed long-term care, the $300,000 would become $12,000 a month until the death benefit ran out. But by the time he turned 90, his death benefit went from $300,000 to like up to $500,000.
Okay.
Does that make sense?
Yeah, no, it does. It does. Okay, so we talked about age range as far as the length goes, but what I'd like to ask is, what's the ideal age range for someone to start considering long-term care? And I think you already answered that. It doesn't matter.
That's right. Because I'm already attaching it to automatically to people that are buying policies from me that are 25 years old.
So are you saying that, I'm just going to kind of hypothetically, so you're saying that if someone has a child, can they put long-term care on their policy as a child and just let it ride out? No. So that's why I say so give me, and not ideal age range, but where does it start? What age range do you start considering long-term care for people?
I never even have done that with an 18-year-old, but I already know that I've been doing it with people that are 25 and above. 25 and above.
Okay. So how do you advise clients to assess their coverage needs based on like their health or their financial circumstances and things like that? How do you get that? Sit down with them, and how do you look through that with them?
Well, okay. So when we're talking about the hybrid life insurance long-term care plan, I mean, it only makes sense if we're doing something $250,000 of death benefit or more. Mm-hmm. Because, I mean, think about it. $100,000 death benefit gives you $4,000 a month. And $4,000 a month, it's reducing your death benefit every time you get the payment for the long-term care. So I like to make sure that people have more. And so usually when I'm dealing with somebody 25, 30 years old, I'm usually dealing in death benefits of $250,000 or more anyways.
Right.
So that's kind of like my standard.
Okay. So when we're talking about long-term care, we're talking about hybrid, we're talking about all these different plans. Are there any current trends or changes in long-term care policies that people should be aware of? Now we're talking long-term care. Is there any changes in the policies as far as that goes?
Yeah, there is an asset-based long-term care that's also available through various companies. Now, the way the asset-based long-term care plan works is people have been putting money in savings accounts at the bank. Maybe they've got $100,000 there where they're earning, say, 3 to 5%, but they're also paying taxes on that interest that they earn. Well, you could take that money and you could shift it from the bank account into it's also a single pay life insurance policy. And as a single pay life insurance policy, On 100,000, your death benefit would be 125,000. So if you died, you'd get 125,000. But it also doubles as long-term care, and it actually triples the amount of the deposit. So if you have a $100,000 deposit, your long-term care benefits would be $300,000, and it's guaranteed to increase every year, guaranteed. So if you started this at age 50, and by the time you're age 80, the $300,000 might be worth $600,000 or $750,000 in long-term care benefits that could be paid either nursing home, assisted living facility, or in-home health care.
Okay. So I want to shift a little bit here into the real life application. Okay. So, and I know you like to tell your stories because you got a ton of them. I know you have a ton of them. Been in the business 31 years. Mm-hmm. Can you share a real life example of a family impacted by the lack of long-term care planning?
Well, Jake, really what I want to do is tell you about a family that benefited from buying.
That's the next question. So let's go with this one because I want to hear about the family who didn't have it.
Well, I mean, the families that don't have it are usually losing about anywhere between $5,000 to $10,000 a month, and I'm hearing about these stories everywhere.
So talk to me about that. So we're talking $5,000 to $10,000 a month, and from what I'm understanding of conversations that we've had in the past, is that's what it costs to care for someone in a long-term care facility at this point in life.
Correct,
right?
And their nest egg is getting eroded every time they have to pay the money. The nest egg is reducing, and if you take, say, $5,000 a year using a low number, $50,000 a year, you could see how a $250,000 nest egg would reduce to zero.
In 5 years.
Yeah, 5 years.
It's lasting them 5 years.
And the average stay is 2 years.
The average stay is 2 years. Mm-hmm. Wow. Okay. So now let's shift into one that benefited from it. Let me hear that.
Yeah. So I'll mention Bobby's name because he's a real good friend of mine, Bobby Grimes, and Bobby Grimes, his mom, she started to exhibit forgetfulness that he noticed. And he is an only child, and he spent a lot of time with his mother, and he realized that he needed to have a plan in place for her. And so what happened was he reached out to me, and part of the underwriting process is for a standard long-term care plan is that they will do a cognitive test on you. In the cognitive test, they'll ask a series of questions, and then they'll go back and ask again and see if you say the same thing or if you get confused. Mm-hmm. That might show that maybe you might have a cognitive impairment. So she was able to pass that, and she was in the policy for, I believe it was about 4 years when she came down with Alzheimer's disease. And then, but here's the thing. He ended up buying her a lifetime plan, which is a more expensive plan than just your normal, maybe a 2-year, 4-year, or even a 6-year plan. He purchased the Cadillac of plans. He bought, and it turned out to be a real success story because, as you may or may not know, people that have dementia or Alzheimer's sometimes can, if they're in good health, they will live a lot longer. And so she lived, and that policy paid for her to be in a really super nice, 24-hour care place, and it was covered at 100%, and she lived like 9 years after her diagnosis.
Wow.
Yeah.
Okay.
So
and we were talking a little bit ago, and I think the last time we had a conversation about this, at $5,000, $10,000, $15,000, even $20,000 a month it could cost for long-term care. Right?
Sure.
Okay, so I want to encourage our listeners, consider this. Consider how you would handle the cost of long-term care insurance, or just care for a loved one without long-term care insurance. What would that do to your nest egg, your family's nest egg? Because at that point, if you don't have it, everybody's pitching in. And you told me a story about that where everybody's pitching in, and then boom.
And it's not even just money. Think about, shifts of the uncle, maybe the brother is here taking care of, you know, mom and dad, and then the sister comes in, and then they have their own families, they have their kids, and then and grandkids, and and it's not easy work.
No, it's not.
It's picking up dead weight, helping them along. And I see, where generations are actually doing the long-term care help.
I've seen this twice. Already I have seen this twice in just the last 3 years, 2 or 3 years, where, my better half, she had a grandmother and an aunt who both were cared for in the living room. Now, one of her aunts is a long-term care provider. She gets paid to do this, but then she had to have her own mother in her living room on a bed. And I watched them. As a matter of fact, I helped them lift. It was not easy. And then her aunt, in her sister's house, passed there, and they had to take care of her final days, and it wasn't easy. And we're not talking about just financially easy, but emotionally easy. It's having to look at them every single day of your life at the end of their life, watching their life pass away. Mm-hmm. That's not got to be easy. So, what I want to say is that my last question to you is, what advice would you give to someone who thinks they're too young to consider long-term care planning?
Well, I would just say that you have to plan. You're planning for everything. If you're planning for your retirement, you're planning for protecting your family, you're a young person, you got young kids, you might as well do this planning too, because especially with the universal life policies that we sell today, those particular policies are like Swiss Army knives.
Yep.
There's so many things that it does. Number one, protects you if you die. Number two, you create, income, the possibility of creating an income stream as you age with the internal cash accumulation. And then on top of all of that, it can also be a long-term care plan if, God forbid, you ever need it.
And we were just talking before we got on the mic about a client that I'm dealing with right now who's got him, his wife, and a 2-year-old. Mm-hmm. And we're talking about setting up that 2-year-old on a universal life policy that will accumulate that cash. So when they're 18, 20, 25, they're looking at being able to take out a loan at their own money and be able to provide something for them. Mm-hmm. Plus they have the death benefit on top of that. So all of this kind of plays hand in hand. We go from insurance, different types of insurance policies, to long-term care, and that kind of brings us to the close of today. And Javier, I want to thank you for all that you provided, man. It's been a wealth of knowledge. I suggested bringing you back next week, and we shifted on that. So we're going to bring in David Fox, because we kind of both talked about that. David Fox is our business guy, and we're going to talk about financial planning and business. It's kind of going to go hand in hand with this, and it's going to launch off of this platform. So I really appreciate you doing that and suggesting that for the show. Any last words? Any plugs? Any last words you want to have?
Oh no, I'm just really grateful to be in this business, and hopefully the business will that you'll experience the same thing, and that is that I'm not in this life insurance long-term care business. The long-term care life insurance business is in me.
All right, Javier, man, that's awesome. Thank you very much. I want to thank you for coming in today, and until next time, thanks for tuning into the Evans Legacy Financial Podcast. If you got value from today's episode, share it with someone who needs to hear it. Don't forget to subscribe and follow us for more real conversations that move the needle in life and business. Until next time, keep building, keep growing, and never stop chasing what matters.